Welcome to Optimal Insights, your weekly source for real-time rate data and expert capital markets commentary, brought to you by Optimal Blue. Let's dive in and help you maximize your profitability this week.
All right, welcome everybody. Bonus episode of Optimal Insights. I have James here to chat with us. James is on the desk. We have been just all in a flutter about the word on Truth Social yesterday from President Donald Trump. You all have probably seen posts about it or you've seen articles written in the mainstream at this point, but we want to be sure that we had a real quick bonus podcast to chat through what this could mean. This idea of the administration essentially ordering the GSEs, Fannie Mae, Freddie Mac, to go out into the market and purchase up to $200 billion in MBS. So what does this all mean, right? So $200 billion in MBS. There's no plan out there yet, so we're speculating at this point, but trying to kind of triangulate what this could look like for our industry, for mortgages, for mortgage rates, for borrowers out there, for anybody who's really has any interest in interest rates and what's happened so far. So rewind to yesterday, so Thursday afternoon, very close to the close of the market, by the way, which is interesting and somewhat disruptive. But within about 15 minutes of the bond market closing, Donald Trump essentially tweets or posts on social media this idea of $200 billion being purchased by the GSEs. Now, the GSEs typically don't buy or haven't since the great financial crisis, haven't purchased a ton of MBS on the open market. They used to do that as a matter of course. They would use that as a tool to manage mortgage spreads, right? The spread we talk about on this podcast, you've seen it elsewhere, the difference between treasury rates and mortgages, essentially, what borrowers are paying for houses in terms of interest rate versus what like the US government pays to borrow money. But since the great financial crisis, the GSEs have been not prohibited from doing that, but that's not been part of their MO. So now they get ordered to do this. What does that mean? So instantly the market starts to speculate and rates dip, MBS prices surge, right? We have what's called a rally, right, James? And what do we see? Yesterday we saw kind of a mid-level rally. This morning we saw kind of a huge rally, a bigger rally than we've seen in months or maybe a year or so.
Yeah, end of day yesterday, we were sending photos back and forth of it. It was like a 10-tick rally. So that is enough it's going to show up on your shock reports, right? You're definitely going to see that. And with like 15 minutes left in the day, it was, can we rehedge this? Waking up this morning, everyone knew the market's going to keep going. It's going to jump again. We saw another 10, 15-tick rally. It's cooled off and the spreads were like blown out. It was more than 10 this morning. I was looking at the uni 35%. So if you had held out until rolling until this morning, it was definitely a rough wake up to see. The spreads have tightened back up. I think people are kind of setting in, thinking a little bit more about what this means. We were joking about this, like the market reacted immediately as if the administration had put Delta Force on this one instead of Fannie and Freddie, right? Like they're rappelling down, they're just getting the bonds quickly. This is going to take some time, we assume. There's no plan that has been laid out yet. So how are these bonds going to be bought? Really, really importantly, like which bonds are going to be bought? Are we buying uni 30s? What about 15 years, the dwarves or Ginnies, right? Ginnies it's a government portfolio. You'd think they'd step into it, but they traditionally have not. So what about the coupons, right? Are we going to buy 5s to try and get it down? Or are we, hey, there's a couple of, 4.5s or 6s that are kicking out there. What is the range that we're looking at? Or are we just going to purchase $200 billion worth all at once? That seems unlikely. That would be a
bazooka,
a poor strategy. Yeah,
that's a great point. All these different pieces of the plan have yet to come together. The Ginnie Mae piece was a big one because if the idea is to reduce the cost of home ownership, especially for first-time home buyers, FHA, VA, like that tends to be the vehicle to do that versus conventional, which would be more for folks who are maybe already own a home or have more cash on hand or looking to refinance. Folks are a little bit more financially mature, I suppose, or just have owned a few homes before. So we will see. I think, one thing that's worth noting and has been noted out there is 200 billion sounds like a lot, and it is a unbelievable amount of money, but in the grand scheme of the mortgage securitization or the mortgage market, it's not. Like during COVID, the Fed was buying upwards of $100 billion a day in MBS. So let that sink in, right? So this 200 billion in those terms would be like 2 days worth of origination, which is nothing, right? In today's terms, though, it's, we're about a $2 trillion industry at this point, right about 2 trillion last year. So it'd be about 10%. So call it a month's worth of originations. So that's not nothing, but it is kind of a drop in the bucket on its own. But a lot of folks now are wondering, is this just the beginning? Is this an indication that the administration is firmly focused on this and is starting to come up with some real ideas with some teeth in them, right? We had the 50-year mortgage thing, which is, again, creative, but didn't get great reaction. We had some other news the other day about prohibiting large corporations from buying single-family homes. That is, again, a good idea, but likely not to have an immediate impact. And depending on who you ask, does not address a huge part of the market. But this is a big deal. This is cute. You could call this quantitative easing. In a way, it is. You have sort of an artificial demand that suddenly appears to buy mortgage bonds, which drives yields lower to some extent and for some period of time. Just the same as the Fed. When the Fed came in and bought trillions of dollars worth of MBS, it drove rates extremely low for a very long period of time. So could this be just the beginning? Did it start with 200 billion and then they capitalize elsewhere to buy another 200 billion? Or could, when we have to see turnover at the Fed, which will definitely happen, Jerome Powell will be out here in the first quarter and there will be a new head of the Federal Reserve. Will they then be more likely or more open to things like quantitative easing, even if it's not quite like what we saw during COVID, but could be more along the lines of what we've talked about on this podcast, which is right now, anytime a loan that the Fed currently owns pays off, they allow that loan to fall off their books. Could they tighten up a little bit there? Could they eliminate the tightening that they're doing in the MBS space? That would be something relatively easy for them to do mathematically, just to say we're going to keep our portfolio or maintain our portfolio of MBS versus let it run off every month to the tune of 18 to 20 billion.
And there's definitely a lot here that we've kind of been talking about over the past year, right? Like, hey, looking back to pre-2008, Fannie and Freddie were the buyers. They were the main buyers of MBS in the market, and they were helping to keep rates low. You cut to 2008, they have to be bailed out. It's TARP. It's the government who steps in, starts doing quantitative easing. They're helping to keep rates low. We're slowly easing our way out of that. Come COVID, it's like a new wave of quantitative easing. It was about $1 trillion were purchased from like 2020 to 2021. So hundreds of billions of dollars being spent to do that, to keep interest rates low. The government they've backed off, right? Quantitative, was it tightening? And then we've stopped buying them. This is letting the hose back open, right? To purchase it. It is, $200 billion is only going to stretch so far, as crazy as that is. It's only going to go so far. Will the government be open to more? We talked earlier this year, there kind of needs to be a buyer for MBS in order to keep MBS flowing, to get the money back to the banks so they can give more mortgages, so that they can keep rates low, right? Like that is the game plan. That's the system. It does make sense. And there's a lot of analysts who are predicting like this could be, 25 basis points, which it would be great. That's, $120 a person. If you're a first-time home buyer, that really, $1,200-$1,300 a year, that could matter a lot. But, finally, it's the conversation of, we've been talking about, will they let the GSEs go out of conservatorship? And now here is, here's the benefit of having them. They make a lot of money, and you could potentially use that to put it back into the market and use them as a branch of the government. So it's an interesting step and not expected. And finally, we've been talking about, it is good that ideas are coming, right? The 50-year mortgage wasn't quite the hit, but the administration is making decisive action, trying to get affordability under control and help borrowers. This is, how far will it stretch is the question, but this is a big first step that makes sense to a lot of people.
Agreed. It is the bazooka that maybe we were waiting for. You got to love the fact that nothing is off the table with this administration. And this has hopefully been some indication that there's some change of focus, like you said, from focusing on maybe tightening up treasury yields to tightening up mortgage spreads. And if it's just the beginning of that, and that's going to be the trend, it can be a quarter point now. It could be, if they get creative on G fees and LLPAs like we've talked about in previous months, that could be another eighth, maybe another 20 basis points. You start getting, I think we'll probably, unless rates spike for some other reason, we could see a 5 handle on the OBMMI here in the very near future, which would open up a lot of origination opportunities for home buyers, but also for refinances. So good for the industry, hopefully good for housing as well. So how do we sum this up, James? I mean, right now we don't know much at all. We know 200 billion. We know the focus is still on affordability. That's hopefully the administration kind of focuses on that for a while. That's the thing. Meanwhile, some of the geopolitical stuff will play itself out. This is just the first step. Don't expect rates to be 100 basis points lower in the next few weeks by any means. But keep an eye on this kind of saga. We'll continue talking about it on the cast. But for today, we're getting this sort of speculative move. This has not happened yet. Like you said, Delta Force didn't come in and just start buying MBS or snagging them from banks. This is just the speculation that it is going to happen. There will be a plan that comes out, hopefully, with some sort of urgency and some sort of strategy to make this happen over a general period of time in the right coupons, as you said, so that we get the best bang for that buck, so to speak, for that 200 billion to soften up this market to the point where we can see rates in the 5s for a while.
That's an excellent summary. And it's definitely been a week with a lot of mortgage news going on. Non-farm payroll came out today, so we'll have a lot more to discuss on Monday. It's plenty to study this weekend.
Yes. All good things for mortgages so far. So stay tuned. All right. Thank you, James. Thanks for the quick bonus podcast, and we'll talk again here on Monday.
Thank you, Jim.
Have a good one.